You can find a company with a pristine balance sheet, zero debt, and soaring revenue. But if you buy that stock at the absolute top of a market cycle, none of those numbers will protect you from a massive drawdown. Fundamental analysis helps determine what a company is worth, but it won't help you time entries. Have a rigid mathematical system to define your exact moment of execution. Price action is the study of raw, historical market movement. It requires stripping away the clutter and looking at what buyers and sellers are actually doing right now, without relying on predictive algorithms to guess the future. Most amateur traders clutter their screens with lagging indicators, trying to guess market direction. Institutional players operate differently. They rely on pure structural demand zones, waiting patiently at the edges of the market to trap retail liquidity. This chart shows the danger of trading in the middle of a range. We call this choppy, directionless middle area the avoid zone. It is pure market noise, where retail traders are routinely chewed up by volatility. To execute like a professional, your very first step is identifying this chaotic mid-range and actively refusing to participate in it. Let's test this on a real-world asset. This is Reliance Industries. It is a highly liquid, institutional-grade market leader with massive economic weight, making it a perfect candidate for clean price action analysis. This chart displays Reliance's daily price action. At 1,430 rupees, the market is clustering in a consolidation phase. Look down to the 1,350 range. Historically, this is a heavy demand zone where institutional buyers stop the decline. Look up to the peaks near 1,448. This overhead resistance is the exact ceiling where selling pressure routinely overwhelms buyers. By mapping these extremes, you create a disciplined boundary. You simply wait for the market to come to you. Now we bring in the technology. We start by applying a 50-period exponential moving average, or EMA, which acts as a dynamic filter to identify the broader market trend. Next, we add the relative strength index. For a valid long entry, we need this oscillator reading above the 50 baseline to confirm there is actual positive momentum behind the move. On this updated chart, we apply the AI Supertrend indicator. This machine learning script serves as the definitive algorithmic signal to authorize your execution. Here is the non-negotiable rule. These AI indicators strictly confirm a price reaction at your pre-drawn support level. You never use them to blindly execute a trade in the middle of a noisy chart. When you align algorithmic indicators with physical chart structure, you move from guessing entries to executing based on repeatable evidence. We can compress this entire workflow into a mandatory 4-step sequence. You identify the trend, you wait for the level, you read the AI signal, and you verify the momentum confirmation. This is the pullback buy. Price hits demand, RSI holds over 50, AI Supertrend turns green, and a bullish candle breaks upward. Your entry. Stop loss goes strictly below structural support at 1330, and your target locks at the 1448 resistance. Another path is the breakout trade. This setup requires the price to push through the 1450 resistance level on a significant spike in volume, proving that the overhead supply has been fully absorbed by buyers before you enter. Adhering strictly to these parameters separates professionals from amateurs. You are no longer guessing, you are operating a high-probability business model. Before risking actual capital, you can mathematically verify this entire system using TradingView's bar replay feature. Watching your AI indicators react to past breakouts exactly as they unfolded builds immense psychological confidence. You see the failures and the successes in real time, removing the anxiety of the unknown. We do not predict the market. We use pure price action to find